Good afternoon. This is Jim Denholm, founder and CEO of Ironbridge Private Wealth in Austin, Texas. We put a webinar together last Thursday, and due to user operational technical errors, I forgot to somehow I didn't record it. So this is the recording from last Thursday. Everything is the same. It's not out of date at all. So we're going to go over the post-election results, and especially focused on economy and stocks. We're going to go over the betting markets. We were looking at that before the election. They ended up proving correct, much more accurate than the polls. Stocks had a crazy good week, just on the back of the election being over. There is some food inflation that I think did affect the election. VIX, we'll look at historically VIX around elections, presidential elections. Our case for interest rates going up despite the Fed cutting. Small caps look really attractive. We started to see that, finally come to fruition last week. And really, it's pretty similar to the 2016 election so far. So let's go ahead and jump in. We had some questions at the webinar. I'll try to cover some of that as well. But this was the betting markets prior to the election. Right in the early October, that Trump just started to take a fairly commanding lead. Is when it was about the time where Trump went on Joe Rogan, and Harris went on some other podcast, and it just looks like, from a media standpoint, it looks like that is probably going to be a bigger deal than we think right now. So. We'll see. But the betting markets were much, much better at predicting the election than the polls. It's just a better thing to look at going forward. Swing states. So, the polls had all over the place. There were plenty of swing states that had Harris way up. Most of them were pretty tight. The betting markets really favored Trump, and that's what ended up happening. So, the betting markets are more objective than the polls. Polls can be worded in a lot of different ways. The betting markets, it's profit and loss. They want to win money. So they don't really, it's a profit motivation, not an ideological motivation. And I think that makes it more accurate. Some of the stranger betting market thing that I saw, this is from Thursday. And after the election for Trump, there's still a 4.2 chance that he will not be inaugurated. So there's, 1 in 25 chance that we still see some craziness. It could take a lot of different forms, may not be anything, but just something we probably need to keep in the back of our mind, that there could be some craziness yet to come. Post-election day, it was the biggest post-election market return in history, from a percentage standpoint and a point standpoint. And it reminds me of 2016. The small caps really had a great couple of days, up almost 8%. NASDAQ 4.5%, Dow 3%, S&P 3%. The S&P finished the week up 4.5%. So, it was a big move higher. I think the markets were expecting that the results would not be finalized last week. And I think if it was, my perception from a lot of different things is that market was going to be pretty patient till Friday and have a lot of volatility this week if we didn't get an answer. So part of the results last week, part of the reaction last week, was just the fact that it was done, and it was good. We'll take it. Stocks around election day. We showed this prior to the election. It looks pretty similar now. The typical behavior of the market in an election day or a presidential election cycle is that you have a trend. So if the trend is up going into the election, you get a little pause and the trend resumes. We had two downtrends since 1980. It was 2000 and 2008. 2008 in orange. There was a mess that really didn't have too much to do with politics, but you could argue that. But even there, it was volatile, very volatile. But essentially, we were flat for almost a month. No price movement, a lot of volatility, but no price movement. And then the presidential election happened. That was Obama, and the market resumed its trend. Blue is 2000. So we had the tech bubble that was bursting here. It started a downtrend over the summer, and it paused a little bit before the election. Trend resumed downward. This year, the trend is up going into the election on good data, on pretty good economic data, good earnings data, and the trend is resuming itself. So it doesn't look like there's anything abnormal from a market standpoint that's happened, and almost from an election standpoint, which is really surprising given this election. So looking at post-election, what tends to happen? So this looks at since 1928, the first election that happened after the S&P started. The returns are pretty good. If we look at an average return, 1 month, 3 months, 6 months, and 12 months out, average for every election is a 7% return over the next 12 months. And it's higher almost 60% of the time. The last 10 elections, 15.2% higher the next 12 months, higher 90% of the time. So, markets tend to go up. And if we're in a decent environment around the presidential election tends to not matter all that much. And that's been the case again this year. From a market standpoint, over the short run, not necessarily saying anything about the candidate or losing candidate or winning candidate or anything like that. It's just what the market tends to do. I think this was a bigger factor, and it is a nice visual. We probably should kind of go to some basics with this every once in a while. But when we look at the inflation rate, when we talk about inflation coming down, inflation is not deflation. So inflation coming down is very different than prices coming down. And this is just a nice chart that shows it. This shows the US in blue, UK, Eurozone. And, from COVID, but really from 21, 22, we just saw massive inflation in food prices, 30% inflation over a couple years, which is big. And inflation is now down to 3%, give or take, but that just means it's going up more slowly. So, this massive spike higher is what I think voters are looking at. And I think that was a pretty big deal that may not have been talked about, but it's a good thing to keep in mind too. Decreasing inflation is not prices going down; it's prices going up more slowly. So I think we're going to see a resurgence in inflation as well. But I think this is a bigger deal for the election than what a lot of people were talking about. VIX pre and post election based on the market data, pre and post election, you'd assume that this would look like this, but it's nice to actually see it. So this is the VIX. So the 0 day is the election day, and you go back 100 days and out, 200 or so, kind of well into the next year. You tend to get a VIX spike higher. This dark gray line is the historical. The red is this year. Red is this year, and the gray shaded area is the 25% to 75% percentile. So, the bulk of your data is right there, and then the dark gray and the average. So it's happening the same way this year that it tends to happen. You get a moderate spike up in the VIX, and then you see it kind of slowly fall as people realize that, maybe the candidates aren't going to, put everybody in prison like people predicted. I personally think the politicians should be in prison, but I digress. So far it's behaving, the market is behaving as we would expect around a presidential election. Thursday, Fed cut another 25 basis points. They're saying inflation's on pace to get down to their 2% goal. It's going to be an interesting year. I think this is now that we've had a few more days after the election, almost a week after the election, there's already starting to be some talk about ending the Fed. I personally think that would be good. You just need the 2-year Treasury. I think the Fed has caused a number of inefficiencies in the marketplace. I think they are solely responsible for inflation. And I think that they are flawed and probably should be removed and replace the Fed funds rate with the 2-year Treasury. But we'll see. And there's going to be some consequences to that. So it's, we're going to have to pay attention to some of these bigger changes that could be coming out. I think if we see something like that, some of these bigger changes that Trump's talking about, I don't, obviously nothing's going to happen until next year. And it's probably not going to happen until later next year, if not 26, if it even happens. So, I think we've got to take a lot of this stuff with a grain of salt right now until Trump gets inaugurated and we start to see what's really going to happen. But despite this, one thing I'll point out is we saw this 50 basis point cut in August and a 25 basis point cut last week, and we've seen yields go up almost 100 basis points. The market is not in alignment with the Fed. The market thinks that we've got higher yields to go based on what we're seeing. So we don't think interest rates are going to go back down unless we get a big recession. And that is not in the cards just yet. I think we've got at least 6 months, if not 12 months, before we'd see any kind of recessionary environment based on the data. But it does look like we're going to see some higher yields going forward. One of the main reasons for that, this looks at the treasuries that are maturing over the next few years. I've said this in one-on-one meetings. I think we said this a couple times on videos or reports. But the U.S. government really messed up a few years ago with not offering extremely long-term debt. So, interest rates 3 or 4 years ago were the lowest in human recorded history since financial records, and they can go back to the ancient Egypt. And it's the lowest they've ever been in planet Earth. And they did 5 to 10 year bonds. They should have done 100-year bonds. They should have done 50-year, 70-year, 80-year, 100-year bonds, lock in low rates for a century, and you'd have so much more flexibility. Now, interest rates, and that's when interest rates were at 0, so they probably could have had a 100-year bond at 2 or 3%. Now, if they want a 6-month bond, it's going to be 4.5 or 4.75. So they've got, it was just a big mistake. And so now, as a result, all of these bonds that are maturing are going to have to get absorbed by the marketplace. And anytime you have increased supply, especially massive increased supply, prices go down. And when prices go down in bonds, yields go up. So when you have this much supply, the market will demand higher yields. If they have to fund all this stuff, the market's going to say, okay, we'll buy a little bit at 4% or 5%, but if there's $10 trillion you're trying to sell, I want 5.5 or 6%. So you don't know what the market's going to do, but this is a lot of debt maturing. So the total outstanding debt with the U.S. government is about 30 trillion. About 16.8, 17 trillion or so is tradable. And tradable means that it's in a, somebody's account, whether it's a hedge fund or retired family or a sovereign wealth fund or hedge fund or insurance company or whatever it is. There's about 17 trillion held that are marketable. The difference is about 6 trillion is owned by the Fed, and they're just letting those mature and roll off. And then, at least right now, and then the rest is by the Social Security Trust, which is basically a lie. There's no money in there, but there's treasuries that need to get funded to pay Social Security. It's kind of a Madoff, frankly. They're taking new money in and paying the old Social Security out. So, they've got to do something. The government is a mess. But we're looking at $11 trillion maturing. As of right now, we've got about a $2 trillion annual deficit. So over the next 5 or 6 years, 10 trillion plus 2 trillion over 5 to 7 years, that's 10 to 14 trillion. So we're looking at 20 to 25 trillion dollars that needs to be absorbed by the market over the next 5 or 6 years. And like I say, outside of panic, that's a lot to unload. And that's incremental upward pressure on interest rates. Debt maturing is not, you're not going to wake up and all of a sudden we have a debt crisis. What's going to happen is every auction, we're going to get upward pressure on yields a little bit at a time. And the marketplace is going to start demanding that as well. Like I say, unless we get a real big recession, it looks to us like interest rates are generally going to go higher. And that we think that's the cycle that we're in, and that we're going to be in this for probably 10 or 20 years of a generally rising interest rate and inflation environment. GDP. So looking at the Fed cuts, this is where it's a weird cut. This is a couple weeks old, but it hasn't changed all that much. GDP now, we've referenced this a few times. It's a good metric to look at to see generally, is there some real-time updates that we can look at? Economic data is always looking in the rear view. So this is kind of as close to looking at the street as you can, as opposed to looking in your rear view. Right now the data is kind of 2.5 to 3% GDP growth for this quarter. Not recessionary. I'm not sure where the recessionary talk comes from, but it's just really not in the data right now. And at least for the next 6 months, I think we're going to be okay. Another economic data point looking at recessions. This is a recession index that basically looks at a bunch of different payroll and income and expenditures data. And what we see is really what tends to happen. And let me kind of set this up. We've got 0% chance to 100% chance up and down on the y-axis. This goes back to about 1960. And what we tend to see, the gray shaded areas are recessions. And what we tend to see is this kind of generally rising probability when it gets below 1 or 2%, or 10 or 20% chance of a recession. We tend to see this kind of rising percentage a little bit before, a year or two before. Almost every time we've seen this, that's happened. The closest to where it just turned higher was the recession in 1970. That's what the environment that we think we're going into. So, maybe we have one of these recessions here in the next 6 months, a year or 2 years. And it looks like we're probably going to flatten out. That's what happened in these cycles. In the 70s, when interest rates were rising, inflation was rising, there were 4 recessions. Markets were flat, 0% return over 14 years between 1968 and 1982. But we did have kind of multiple mild recessions in there. I think it just doesn't look like we have it right now. I think it would take an exogenous event, something outside of the market that comes in, something crazy with Trump, some kind of geopolitics, something like that. I think is going to have to come in and knock the market off at this point. So it's a pretty solid environment for the near term. Last couple more charts. Looking at bull markets, previous bull markets over the last 50 years. This is from Carson Group, Ryan Dietrich. We love his stuff. Thank you, Ryan. The current bull turned 2 last month. when it gets above 2 years old, it tends to not be a bear market rally. So if it lasts more than 2 years, the chances are that it lasts for another 3 years. That didn't quite happen in the 70s. We saw bull markets that lasted like a year to 2 years and turned down after that. So we could see that if we see some interest rates really go up, or if we see, at this point, it could be getting rid of the Fed. It could be something with cutting the size of government. It could be war. It could be a lot of different things, but the chances are that we still have room left in this bull market. I don't necessarily, what this chart shows is the length, the percentage return and duration of the last 6 bull markets. And we're right down here. This green line down here is the current bull market. Pretty much in line with most other bull markets, frankly. Kind of starting out. And if you look, we kind of get a little pause here, and then it just sort of, chugs higher. We'll see if that happens. I don't think we're going to get one of these that goes way out here and goes up 600%, but you never know. If we'd love it if we did. But I would expect that we have a year, 2 years, maybe 3 years left before we start seeing any kind of, bigger, broader, extended downturn. Small caps, with that backdrop, we've really liked small caps for, most of this year, especially the second half of this year. We're finally starting to see that. And there's really a couple reasons why we like small caps. One is, if this is a bull market, small caps tend to outperform, especially in the early stages of a bull market. We didn't see that this year, mainly because of the regional banks. They have kind of put a weight on the overall index and on the overall small cap, and those are starting to look a little bit better. They're not out of the woods at all. There's still the risk of some commercial real estate chaos to come that would affect smaller regional banks. There is a little bit of a concern that the Fed rate cuts over the last couple months is addressing some kind of bigger bank that could be in trouble, but there hasn't been enough hard data to suggest that, and there really hasn't been any rumors of that either. That would make sense, though, if we saw 75 basis points with some kind of risk of contagion for a big bank. But again, it just doesn't seem likely. But the small caps, from a valuation standpoint, look incredibly attractive. Large caps are fairly valued, if not a little overvalued. PE is about 22. So the small caps are like 14. So on a relative basis, valuations have a pretty attractive relative valuation. This is supposed to say revenue. Revenue also looks better for the next couple of years. 24, this year, the projections were that the large caps were going to dominate from a revenue growth standpoint. I think this is also the banks. The more time, we're now kind of a couple years out, 2 or 3 years out from the start of this commercial real estate sort of problem. Really, COVID kind of started all of it, but each quarter, these smaller banks have been able to set aside money for loan loss reserves. And so the longer that this can get extended, the better it's going to be for everybody. So every quarter that something doesn't start to unwind is another quarter closer to a good ending to this, or at least not a bad ending. So, but as we get past that, you can kind of see that these bank earnings, you're not going to get this kind of big growth just on the back of normal smaller companies. This is a prediction and a projection by the overall market that we are going to see the bank earnings start to rebound a little bit. I think that's That's my opinion on it. And it looks like, I say, if we've got higher revenue growth and better valuations, that's a really nice thing to see with a backdrop of an early bull market. So we are already very much overweight for existing clients, small caps versus our benchmark. We're overweight mid caps versus our benchmark. We're overweight large caps versus the benchmark. And all of that comes from international. So we're overweight US, underweight international at this point. But small caps really do look attractive. Last slide. Yep, last slide. This is the 2016 election. It looks very similar, and in the sense that the prevailing thought was really twofold. One, it's not going to be over on election day. And two, there's going to be chaos. And we didn't see either. So, I think the market was just like, whew. And it didn't get crazy. We didn't have a Bush v. Gore. I was saying the same exact things in 2016. And the backdrop was very similar too. We had a good economy. It was a little bit later in the bull market in 2016. Although, there was a 20% decline in that previous year and a half from the China debt devaluation. But once election happened, we saw this little bit of a pullback. We saw VIX spike. The election was over. I think this could have been called the Hillary rally. It was called the Trump rally. Last week may have been able to be called the Harris rally. Trump won. It's the Trump rally. So very, very similar to 2016, in that the data was just much better under the surface than what elections allow it to be. Everybody wants the things to be super negative, so they can have their candidate in. But the fact is, the economy's pretty good. Earnings are pretty good. Market is very good. And it looks like we've got further to go. So, as the whole, sorry if your candidate didn't get it. It's a weird one, but I tell you what, it is much more calm at this point than anybody predicted. So let's take it. We were positioned well for it. We had a nice big week last week. So we're, kind of onward through the fog. If you have any questions, I know we're not doing this live today, but feel free to reach out. Jim.denholm@ironbridge360.com. You can ping me on Twitter at denholm_Jim. Happy to answer some questions. We'll give some updates over the next few weeks as we need to, but good, successful market week last week with a whole lot of big things. Some of the questions, I was going to go over some of these questions. Some of the questions we got last week. One, geopolitics. Do we think that geopolitics could potentially increase and risks to geopolitics increase? Maybe. We're not political experts, but the early data is that the world thinks Trump is crazy and he will not hesitate to, turn their country into a parking lot. And we've already started to see Hamas and some other places, want to tone down the rhetoric. So, it could be pretty good. It could be that he is crazy enough that it's going to be some peace because they don't want to be killed. But the geopolitics hopefully seem like they're going to be a little bit lessened. It's between now and inauguration, frankly, that's my concern. But again, we're not political people. We talked about interest rates going up, talked about the economy, but basically, the takeaway is the election was done. The backdrop is very good. And barring something really crazy, it looks like we've got a pretty good environment for the next couple of years. So I think we kind of leave it at that. Appreciate your time today. Again, please do not hesitate to reach out with any questions and invest wisely. Thanks, y'all.